Hi, welcome back to Money Talks. I'm Mia Lee, escort, stripper, CPA, and recovered banker. This is part 2 of my 2-part episode on homeownership. In the last episode, we talked about making a decision as to rent versus buy. Today, we're going to talk about the home buying process, what you need to do to prepare for that, also some additional considerations with respect to your financial wellness, and a cautionary couple of tales about investment properties. To start, you might have noticed that home values are incredibly high right now, and that is driven by interest rates and inflation. You also want to think about the impact of high interest rates and inflation on housing availability. There are a lot of people right now who might have locked in 3%, 4% mortgages years ago before the current inflation and interest rate environment who can't afford to move because where are they going to live? They're going to have to buy a new home at 7% mortgage rate, and that's not very attractive to them. If you just wait a little while for interest rates and inflation to come down, there will be more homes in the market, kind of a message of hope if you are looking to buy a home and it's not looking affordable right now. Speaking of affordability, the first step in the home buying process is to determine how much home you can afford, which is another way to say how much mortgage can you afford. Lenders use what's called a debt to income ratio, or a DTI, and they follow the 29-41 rule. You want to keep your housing cost below 29% of your gross monthly income, and you want to keep your total debt payment on a monthly basis to under 41% of your gross monthly income. But let's put some numbers to this with a fictitious example of Jane Doe. Let's say Jane Doe has $50,000 in a car loan, $20,000 in credit card debt, and $100,000 in student loans. Jane Doe, in this example, if she's looking to buy a home, is going to have roughly a $930 a month car loan payment. Jane Doe is going to have $508 a month in credit card payments, assuming that this is credit card debt at 18% over 5 years. Student loans at $100,000 at 6% over 10 years is going to be $1,110 a month in monthly payments. If we add all of that up, we get $2,500 in debt payments before you assume a mortgage. If we add in a $1,900 a month mortgage payment, you're looking at a total debt payment of $4,400 a month. So if we go back to the 29-41 rule, Jane Doe would have to have income of $128,781 at least in order to stay below the 29-41 rule for the debt to income ratio for a lender to issue her a $280,000 mortgage to buy a $350,000 home. If you don't meet this income requirement and you're Jane Doe in this situation, you have 2 options. You can pay off more of your debt, ideally your credit card debt first, because that's the highest interest rate, and you can bring down your total debt payments, or you can put down more than 20% against your mortgage and that'll bring down your mortgage payment. Another thing that lenders are going to look at is the amount of cash reserves you have in the bank after you put down your down payment and all the costs at closing. And this is going to be between 2 to 6 months of your monthly housing cost, not your mortgage payment, your total housing cost. And the reason they want to see 2 to 6 months in reserves is because lenders want to know that after you've outlaid all of this cash, and it's a substantial amount of cash for most people in your down payment and your closing costs, they want to know that you can still pay your mortgage and your monthly housing costs should anything happen to you, if you lose your job, if your business runs slow, or anything financially were to negatively happen to you. They want to see some amount of cash reserves so you can continue making your mortgage and housing payments. Whether you need 2 or 6 months is going to depend on your credit. So the stronger your credit, the closer you are to the 2-month reserve requirement. The worse your credit, the closer you are to a 6-month reserve requirement. I want to talk a little bit about also why you want to put down 20% and no less than that. If you don't put down 20%, you're going to have to pay PMI, or private mortgage insurance. This insurance protects the lender, not the borrower. It's going to be rolled into your total mortgage costs. You're paying 7% on your mortgage, and PMI is going to add between 0.5% and 1.5% onto your mortgage total cost. And it doesn't build any equity, and it's really just a liability, and it's going to increase your monthly mortgage payment, and you're paying interest on something that doesn't help you at all and only benefits the lender. So put down 20%. Another thing you're going to need in preparation for getting a mortgage to buy a home is 2 years of tax returns. If you happen to be one of those people who's playing fast and loose with your income declaration, your cash income, you might want to reconsider that. In addition to that being tax fraud, if you grossly underdeclare your income, you're not going to be able to afford as much of a home, because lenders typically won't lend you money to buy a home that is more than 2 to 2.5 times your annual income. If you want to buy a $350,000 home, lenders are going to want to see income of between $140,000 and $170,000 a year. So if you're grossly underdeclaring your income and you're not declaring the numbers that you need to buy the home that you want, that's going to negatively impact you in the future. When you're ready to start shopping for a home, you want to get what's called a mortgage pre-approval letter. So you can get this letter from whatever bank or credit union you bank with. This is basically a letter saying that the bank or credit union will issue you a mortgage for this amount should you find a home tomorrow or today. The reason you want this is so that prospective buyers and your realtor will take you seriously, because if you don't have this letter, prospective buyers might not entertain your offer because they might think that you don't have the money to buy their home. A cautionary note about mortgage pre-approvals, I'll use myself as an example here, forget Jane Doe for a minute. I was pre-approved for a $3 million mortgage. I am not spending anything close to $3 million on a mortgage. We are self-employed, we are women, we want to live below our means. You want to be financially responsible, you don't want to be house poor, and you want to not have anxiety about the state of your finances. I would encourage everyone, home buying aside, to live below your means. That includes buying a home as a financial decision. Even though I can afford, according to my bank, a $3 million mortgage, I'm not taking on a $3 million mortgage. I like to live below my means. Once you've made an offer on a home and your offer has been accepted, you don't want to just take that pre-approval letter and get that as a mortgage. You want to shop around for rates. Again, using myself as an example, when I was really serious about buying a home under different circumstances, when interest rates were a little bit lower than they are now, I actually was able to get another mortgage offer from a different bank. And that interest rate was lower than what my bank was offering me. So I went back to my bank and I was like, either match this offer or I'm going to take my business elsewhere. And they matched my offer. They might not do that for you, but it's worth asking. So don't be afraid to shop for different mortgage offers and pit the offers against each other to get the best deal possible. Let's talk about some of the impacts and helpful features of homeownership and home equity on your net worth and financial well-being. There's a really cool feature of home equity called a HELOC, or a home equity line of credit. Is basically an amount that you can borrow against the equity in your home. You can use this essentially as your emergency fund. I had previously talked about how we should have 6 months of living expenses in our emergency fund, ideally in cash or liquid securities. Well, if you don't want to have that in cash, you can use your HELOC as your emergency savings fund so that you can free up your cash for investing and wealth generation. This is super useful. It's a really great feature. You can do this tax-free. There are no tax penalties for taking out a HELOC, and it's a really cool feature of having equity in your home. Another cool thing about owning a home is that it provides long-term financial stability. Let's say you have a $2,000 a month mortgage payment. That mortgage payment doesn't increase with home values in your area, rental prices in your area, or inflation. So if we just apply an average of 3% inflation over the last 10 or 40 years or whatever, if you have a 30-year mortgage, your $2,000 a month mortgage payment is not going to change after 30 years. But assuming that rent prices increase just with inflation, assuming no property appreciation, just to make the example easy, my rent would be about 2.5 times higher after 30 years just due to inflation. Whereas if I had a mortgage, my mortgage would still be the same. In that way, it is very attractive to own your home versus renting your home if you're going to live in it for a long time, because the real dollar value of your mortgage payment is going to decrease, whereas the real dollar value of your rent is going to increase with both inflation and any appreciation in property values in your area. One big tip I will give you is don't watch HGTV and get very trigger happy about making equity investments in your home. I know a girl who literally did this and ended up with a $50,000 master bathroom renovation. She was like, it's going to build equity in my home. And now she's basically house poor, but she's a clean ass because she bought a nice bidet. And I don't think that was a really great trade-off. I am certainly not an expert in being a landlord or property management. And because of that, I don't have any investment properties. And I want you to consider both the potential downsides of investment properties, like having a tenant that's not paying, having maintenance issues with your house, and also the incredible amount of time that you have to invest in another business line or revenue stream if that's not something you have an expertise in. It's a substantial amount of time investment and effort and mental and emotional space on your part. And you have to consider whether that time and space emotionally and funds would be better off invested in your core competency, which is your business, your sex work business, or whatever that is. For me, I don't have investment properties because I'm much better at making money sucking dick than I am at being a landlord. So it doesn't make sense for me to trade something that I do better, more efficiently, for something that I do worse and less efficiently. That's all I've got for you for home buying. I'm Mia Lee. You can take the girl off Wall Street, but you can't take the banker out of the whore. Please leave me your comments, questions, and suggestions for future episodes. Thank you so much for listening.